All right, welcome back to the Know Your Numbers REI podcast. Your host, Chris McCormack, CPA, certified tax planner, and founder of Better Books Accounting. You know, some people ask, what is a certified tax planner and how does it differ from a CPA or an EA? And before we get into the episode, I'd just like to briefly touch upon that because I think it's important. So a certified tax planner is a designation received by the American Institute of Certified Tax Planners down in San Diego, California. There's about less than 1,000 of us all throughout the US. I don't know what the current number is. I know when I got it, there were about 600. And so it's much more limited in number and exclusive than just like a CPA or an enrolled agent. What you do is you take certain courses, continuing education requirements to receive the designation. And then throughout the year, you meet with clients and partner with entrepreneurs, business owners, investors, save them on tax, create tax plans, and then you can kind of receive additional designations. So you start out as a certified tax coach, which I was, and then you level up into a certified tax planner once you've done a certain level of service. So American Institute of Certified Tax Planner, great organization, and it's just an add-on for CPAs that want to be at a different level than just a tax planner or what some refer to as paper pushers. So there's that. Today we're going to be talking about cost segregation and how to use cost segregation to cut your tax bill into half. And we know that cost segregation is a hot topic. We touched upon it in a recent episode a little bit, but some people are confused by it. They don't fully understand it. Maybe they're a little hesitant about it because they feel like it could be a money grab or whatever, or is it even allowed by the IRS? So today we're going to be talking about how you can use it to cut your tax bill in half and some of the things to look out for. You can save tens of thousands of dollars in taxes just by changing how you depreciate your real estate. It's not magic and it is not illegal. It is cost segregation. If you're not using it, you're leaving money on the table. What cost segregation is, how it works, who qualifies, and share real life examples of investors shaving their tax bill. We use this strategy on most of our tax planning clients who qualify. By the end of this episode, you'll know if cost segregation is the strategy that you've been missing out on and what you can do to apply it. All right. If you own income producing property, you know the frustration of watching your profits shrink when tax season rolls around. All right. We know that insurance is on the rise. We know that interest is ever changing. We know that property taxes are on the rise. Most investors are stuck using the standard depreciation schedules without realizing that they can accelerate depreciation and save thousands of dollars while doing so just by using cost segregation. It's not the end all be all for everyone. There are plenty of people who it doesn't work for. So again, by the end of this episode, we're going to be clear on who it works for, who it doesn't work for. And if you're one of the people that it does work for, then we're going to want to make sure you know and you have confidence in that. We know that you're working hard to grow your portfolio. We know that every year a huge chunk of your cash flow disappears into taxes. All right. If you're showing a profit on your properties by the end of the year, a lot of it's going to be eaten away at taxes. And we know that some of that isn't even money you have because things like principal aren't deductible, right? It's just the interest portion. So you're selling out some cash that isn't deductible. So why would you want to do that more by using standard depreciation? It would be so much better if you could keep more of that money to reinvest and improve your properties. People are doing this on a regular basis, some even multiple times a year. All right. We have a husband and wife client who have been with us for almost 3 years now. They first came to us because they were worried about their overpayments. The husband brought in a large 6-figure salary, well over $200,000, probably touching on $300,000. And the wife was full-time in the real estate business, but they hadn't met that CPA, that tax planner, that tax strategist that they felt confident in. And as a result, they just felt like they were overpaying. And that was the truth. They were overpaying. They had 5 properties all throughout the US. They traveled to some of them. They spent a lot of time trying to get them and cash flow on them and improve them and repair them. And so they were pretty stressed out. They were worried that taxes were just another thing that wasn't going to go their way. So I sat down with them, and within our first meeting, I found ways that they could save about $50,000 in that first year. $50,000. Okay, you might not even have a $50,000 tax bill. That's incredible. And so if that's the case, then it carries on to next year and years after that. So we implemented a plan and they were able to get that. I think it ended up being a $30,000 refund in year 1. And then year 2, they kept working with us. And because they had this large portfolio that continued to grow, we were able to get another refund in year 2. I think it was about $15,000 to $17,000. So between the 2 years, They were worried and stressed about where they were before coming to us. And then by the end of the year, the second year, just through certain real estate strategies, most notably cost segregation and changing the way that they depreciate properties, they had $45,000 in their pocket that they didn't have prior to working with us. And now they continue to expand their portfolio and dream of retirement, right? They're looking to leave the job that the husband holds in here a few times and just go all in on real estate and retire there. So imagine if these two kept using the standard schedule. They would still be paying more than they needed to, missing out on the money that they now have and missing out on the properties or the improvements to their properties that have come as a result of that money, right? It's not just the money that you're currently missing out on. It's what you can do with that money, right? It's the travel. It's the reinvestment in the properties. It's the additional properties that you purchase. It's the new business. It's the college education. It's the kids entrepreneur fund, right? These are things that people on a regular basis we talk with, and these are things that they've been putting off, and they know that if they weren't so worried or if they just had confidence in their taxes, that is where the extra money would go. And the worst part is that this is an entirely legal strategy that most people are missing out on because they just take what is given to them by their general tax preparer or what they're putting into TurboTax. Let's discuss it. What is cost segregation? Cost segregation is exactly what it sounds like, segregating cost. So when you buy a property, you invest in a property and the land that the property is on. Here's a news flash, people. Land is not depreciable. All right. I review tax returns and there are people that are depreciating that land, and that's not the case. And if you're doing that, well, that is illegal. And so you're either opening up the door to a lost audit, or you are just scraping by and lucky and fortunate and blessed enough. I would say lucky because it's not a blessing. Lucky enough to not be in the middle of an audit and losing that audit and paying the interest and penalties and taxes. There are tax preparers that still, I mean, if you're going to H&R Block, if you're doing it on TurboTax, if you're going to people that aren't specialized in the real estate industry, you could very well be depreciating land without even knowing it and opening yourself up to unnecessary risk. Okay, so that's part one. Make sure that you're not depreciating land. But the second part is that part that is attributable to the building, right? It's called 80, 85, maybe 75% of the purchase price is related to the building. And some people use far too low of a percentage and you miss out on depreciation because of that. That's a whole different story. Cost segregation is taking that 85% of the purchase price. Say you buy a property for $1 million, just for round numbers, and 85% of that is $850,000, which is attributable to the purchase price of the building. In that building, you have light fixtures, you have walls, you have carpeting, you have windows, you have piping, you have all of these different pieces of machinery and supplies and materials that go into building. Okay? Did you know that certain assets have different depreciable lives? Building, a building is typically 27.5 years, maybe even 39 years, depending on the type of building. Commercial properties are 39-year useful lives. Something like a washer or dryer is a 5-year useful life. If you buy a property and they include the washer and dryer, which might seem a little crazy, but there are townhomes, for example, will have that. If you do that and you just take the purchase price and divide it over 27.5 years, then that part that is attributable to the washer and dryer is being depreciated over a longer time period than it needs to be. And you're wasting money. You're spending more money in taxes as a result. So what we do when we do cost segregation is we break it out. What's the 5-year property? What's the 7-year property? What's the 15-year property? What's the 27.5-year property? And we have engineers come in and do this so that we can have full confidence that it's broken out in a level that is legal and ethical and right, and also gets us the largest depreciation expense. So it segregates 5, 7, 15, 27.5 years, the cost associated with those properties so that you can have more depreciation in earlier years and pay less in tax. So then you ask, who qualifies? Who's this for? Real estate professionals are great. If you qualify for real estate professional status, bread and butter. This is a great opportunity. But most people say they qualify for real estate professional because they do realtors, because they sell properties, but they don't spend enough time in the real estate business to qualify. If you have a short-term rental business, you have a very high likelihood that you're qualifying. Cost segregation works best for properties that are more than $500,000 just because there's greater opportunity, right? Because you have more cost to spread into that 5 and 7-year property where you can get a larger depreciation deduction. If you bought a property in, say, Detroit, Michigan for $120,000 off of an auction, that's probably not the best property to be cost segregating. Unless you put $300,000 worth of work into it, and now this great property on the block can qualify for certain deductions in the useful lives of 5 to 7 years, then that's great. But if you're buying a Section 8 house in Detroit, Michigan off of the auction, chances are you're probably not going to have a lot of opportunity in those spaces. Okay, if you're a W-2 earner, if you're full-time job is not real estate, then you likely won't benefit from cost segregation unless you meet certain qualifications. And if you're wondering what those qualifications are, then it's best to schedule a meeting. But there are opportunities out there for W-2 earners. And how does it work? Okay, you have to have a qualified engineer or tax professional to perform a cost segregation study. There's a lot of people out there that will go to some low-cost solutions, and power to you, but you want to make sure that it is protected in case of an audit, right? Because you don't want to be dealing with an audit. Not to say that this wouldn't stand up in an audit, but sometimes when you do these low-cost solutions, they're not fully qualified when it comes to the IRS. Cost segregation is actually the preferred way to depreciate because it is depreciating each asset the way that the IRS says. It's not just depreciating everything in 27.5, right? The 5-year property is getting 5-year depreciation. The 7-year property is getting 7-year depreciation. But you want to make sure that you're backed up with the right requirements, because sometimes that are out there that might seem cheap in the short run, they can lead to costs in the long run because you're getting audited and now you have to pay legal and professional fees. So you want to get it an engineered study for that reason, because that is what stands up in an audit. And a lot of these companies that sell the engineered studies, they will even protect it in an audit because they've done this so many times. Okay, so we've covered what it is, we've covered who qualifies, we've covered how it's done. Now the question is, what are the benefits? Okay, boost your cash flow. Okay, we've talked over and over about how tax benefits are one of the 4 pillars of real estate portfolios. Tax benefits, leverage, cash flow, and appreciation. Cost segregation is a tax benefit that comes to those who are qualified. It increases cash flow because you're not paying the IRS more than they need to. So you keep more of that money that's coming in through the rental property. And then you can reinvest that into new properties or into a retirement account or into your kids 529 plan or into your travel budget. Like, you can reinvest it and grow closer to those dreams that you are putting off because you just don't know whether you should do a cost segregation or even if you're getting all of the tax benefits. The benefit too is that it's in line with what the IRS requires. The benefit there is that you're doing things that the IRS is telling you to do, whether you like it or not. The IRS is saying that the preferred way of depreciating is through cost segregation because, as I mentioned, it breaks things out into the way that they're supposed to be depreciated. You're potentially lowering the risk of overpaying taxes in the future because you get tax savings now and then you can reinvest into another property and then you can use that for tax savings and so on and so forth, right? This is something that you can continue to do. So there's plenty of benefits, right? You lower audit risk if you do it correctly. You save on tax, you increase cash flow, you reinvest in properties, you grow your wealth more than you ever thought possible. And those are just a few. You can have confidence in the fact that you're getting all of the benefits of owning real estate. I think some of the objections I hear are usually around costs, like engineered studies are an investment, but they don't take so long as you work with somebody who's integrous, they value integrity, and you have a CPA or a certified tax planner to stand in your corner and make sure that you're getting things the way that they're supposed to be done. You're not going to pay more in a cost segregation study than you would save in taxes, right? Sometimes people pay $5,000 for a cost segregation study and then they find out that they don't get any tax benefits because they were sold it without knowing that they didn't qualify for, say, real estate professional status, okay? So you do want to make sure that you qualify for the full benefits, and you do that by meeting with a tax professional. All right, so some of the other objections might be you feel like you're too small to actually do something like this. You feel like cost segregation is a little more advanced if you only have 1, 2, 3 properties, right? That's not the case. How are you going to get that next property if you're overpaying on tax? Cost segregation is great for anybody, regardless of situation. We've done cost segregation for people that have close to 1,000 units. We've done cost segregation for people who have 1 property. It doesn't matter. If the benefit is there, you should go forward. Some other objections, right? They're not sure if it's qualified by the IRS. We covered that. You can throw that out the window. The IRS knows about this and they know that it is in line with their expectations. The risk, though, is that it's done incorrectly, which is why you need a tax planner, a CPA, an enrolled agent, somebody who is specialized in the real estate industry that you know this is going to be done correctly. Because especially if you bought the property 2-3 years ago and we need to do something like a change in accounting, you're going to want to make sure that the person that's preparing your returns has experience and has the ability to do that. Otherwise, you're going to be swimming upstream. The IRS is going to come and you're going to be like a fish out of water. You're not going to know what to do and you're going to end up paying because it wasn't done correctly. So I like to end these episodes with next steps, right? We always want to make sure that we're applying the things that we're learning. So your next step, if you've never considered cost segregation, now is the time, okay? We're preparing returns for 2024. guess what? You can get a cost segregation after the year end. So you can get a cost segregation and it can still qualify for your 2024 taxes. Meet with a CPA, meet with a qualified real estate tax planner, and find out, is cost segregation the right way to go? How should I apply cost segregation? Am I eligible? And then move forward. So I challenge you, the listener, to meet with a CPA, meet with a tax planner. If you have one property or you have 10 properties, meet with somebody to find out whether you're qualified and whether this is something that would be a valuable add to your portfolio. Next week, we'll be talking about how cost segregation and 1031 exchanges can be combined for incredible tax savings and incredible reinvestment opportunity. You're gonna wanna tune in. Until that time, God bless you and keep moving forward.